Welcome back. As we noted, U.S. bank stocks have reacted positively, very positively, to news of the Donald Trump re-election. Let's talk about it with an expert. Joining us from Portland, Maine is Gerard Cassidy, Managing Director and Head of U.S. Bank Equity Strategy at RBC Capital Markets. Gerard, thanks a lot for joining us on a conversation about a very closely watched sector of the U.S. stock market. You have said in some recent commentary that there are two areas where a Trump administration could be have a material effect on the U.S. bank stocks: bank regulation and bank consolidation. Why don't we start with the regulation topic?
Sure, Paul. Thank you for having me on the program. So when you look at the bank regulation, as you know, under the Biden administration, regulation has been dialed up. It's more onerous, particularly at the Consumer Financial Protection Bureau. Under the first Trump administration, the regulators were much more supportive of the banks in terms of consolidation, but also in the Consumer Financial Protection Bureau. That agency under the Trump administration was really not very active, or you could say it was defanged. So we expect that to happen again. And the reason this is important is the Consumer Financial Protection Bureau has been the agency that's been forcing banks to reduce the fees on credit card late fees, and the banks are fighting that in the U.S. court system. So we think that may reverse back in favor of the banks to maintain the fees that they've been charging. We'd also point out that the controller of the currency is an acting controller. That person is very likely to be replaced with the new Trump administration. And once again, when you compare it to his first administration, you had people in there that were more supportive of the banking industry and weren't as confrontational as the current administration's regulators. And we think that's going to be a benefit for the banks.
Is there reason for concern here about regulation being dialed back too much?
It's an interesting question, and the short answer is no. And the reason being is you might be familiar with what we call Basel III endgame, which is a regulation that is moving through to improve the capital ratios. But as many of the banks would tell you, from JP Morgan and Jamie Dimon, Brian Moynihan at Bank of America, our U.S. banking system today is very well capitalized, the best ever. And in addition to that, the liquidity levels are very strong. So the banking system is very healthy, very safe, very strong. Now, we did have those failures last March, and the system handled it quite effectively.
Okay, consolidation is another one, and that is something that's always of interest to stock market investors. Talk to us about the consolidation theme in U.S. banking.
Paul, you're right. Consolidation in U.S. banking has been going on 40 years. Back in the early 80s, we had over 18,000 banks and thrifts. We're down to about 4,600 today. So consolidation has been a main theme. Now, it's not linear. It goes in waves, peaks and troughs. We're in a trough right now, and we think that one of the reasons has been that the regulatory environment has been uncertain. It's not clear if the regulators are all supportive of consolidation. You have the Federal Reserve, the controller of the currency, and the FDIC, as well as state regulators that all have to sign off on it, and they're not all playing on the same side of the field, and that makes it more challenging for the banks. But also, we also have to keep in mind that higher interest rates have made it more difficult to do deals because of the mark-to-market accounting. When you go to buy a bank, your mark its book to market, and when the bond portfolios are marked today, there's a big drop in value, which means that it's tougher to get deals done.
Who are the likely targets in a wave of bank consolidation if we see that over the next couple of years, and who are the likely buyers, generally speaking?
Yeah, it's interesting because our biggest banks, JP Morgan and Bank of America, are prohibited from buying any depositories because their deposit market share is over 10%. Where we see the real consolidation is going to be between the banks with probably around 50 billion in assets all the way up to 300+ billion in assets. And right now in the United States, when you surpass 100 billion in assets, it's very challenging for a bank to go over that level because of the higher costs of regulation, also the higher capital levels. So we have a handful of banks that are in that 60 to 80 billion level that are going to have to make some tough strategic decisions over the next 2 or 3 years of whether to grow over the 100 billion in asset mark or possibly sell out. And those names include First Horizon, Wintrust, Comerica, Synovus, Zions. All of these regional banks are going to have to come to that decision, and they may choose that the best alternative is to sell out. Now, to the buyers or bigger banks, you have to keep an eye on bigger regional banks that could use opportunities to grow their franchise through acquisition, similar to what they've done in the past. Names include PNC, a Huntington, possibly a Fifth Third even.
Is it fair to say that there's likely another regional banking crisis out there? We just don't know where it is. Another Silicon Valley bank, another bank that's going to blow up?
Yeah, it's a good question, and it is the right one to ask. The short answer is no. And the reason being is that those three banks, Silicon Valley, Signature, and First Republic, the way their funding strategies were established was extremely dangerous, as it turned out, as we saw in March of 23. What I mean by that is that those three banks had over 90% of their deposits in uninsured deposits, meaning they're greater than $250,000. And when you look at the funding makeup of all the other regional banks, none of them are anywhere close to 90%. They all tend to run in the 50 to maybe about 50% side of the equation. So nowhere near what happened with those three banks. And that's why we do not see that being an issue going forward. Now, during a normal business cycle, when we're going to have credit losses, there may be some smaller regional banks that are over their skis, and that could pose problems. But that's certainly not the bigger regional banks, and we don't see that happening anytime soon.
Gerard, thank you very much for this conversation. Gerard Cassidy is Managing Director